Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal, and with me, as always, Hormis Patakia and Reema Tendulkar. Good morning, guys. Well, yesterday we saw markets at least maintaining the gains that we saw. But today there seems to be some profit booking or consolidation, so to say. It's a 60-point downtick that we are looking at the Nifty right now. 25,135 on that one. Mid caps are flat, but there's some positive bias to that. Banks also flat. So while HDFC Bank is lending some support, the others are pushing it lower. So it's a mixed picture as far as banks are concerned. Important flash at the bottom of your screen. Jio BlackRock AMC, it has received a SEBI nod to launch 4 passive funds. The passive market, that is doing really well. There has been a massive growth in the AUM when it comes to the passive mutual funds as well. And do remember, Jio did see a good response to their liquid fund as well. And right now, with the savings bank rates coming down, people are looking at investing more in liquid funds. And now, for more passive funds, that is an offering that we'll be watching out for from Jio BlackRock.
And I think I remember you telling me once that, you can access this via the apps like MyJio or any of the Jio platforms. So it's going to be digitally very accessible, and they're going to eliminate perhaps a distributor or bypass the distributor. So, the question is, will this in a way disrupt the entire AMC industry? Early days, but it's the latest development coming in from Jio BlackRock. They've got the SEBI nod to launch 4 passive funds, so that's a seminal move. But for the markets, as you rightly pointed out, things are on the quieter side. The Nifty and the sensex slightly lower, mid caps holding flat. In individual stocks, Shriram Finance continues to be the top loser. That's lower by nearly 3%. Auto stocks, which raced ahead yesterday, are retracing a bit. Hero MotoCorp and M&M. Both of them are down in excess of 1%. Eternal has a cut of 1.5%. Sun Pharma is losing ground. A couple of metal names are under pressure. And on the way up, it's Nestle, Wipro, Adani Ports, Edison Bank. These constitute your top 4 Nifty gainers right now.
Interesting moves that are coming in. But since we were on the subject of Jio BlackRock, the 4 passive funds, it has been given approval to launch. One includes the Jio BlackRock Nifty Mid-Cap 150 Index Fund, the Nifty Next 50 Index Fund, the Nifty Small Cap 250 Index Fund, and the 8 to 13-year GSEC Index Fund. So these are the 4 passive funds that SEBI has given its approval for Jio BlackRock to be launched, and the stock too duly recovering from the lows of the day after the news that has come in. Some of the other peers as well within the space. HDFC AMC was one stock. That stock was trading at a record high earlier in the morning, and it's continuing to build on those gains even in today's trading session. 1% higher on that stock. So now, based on the current price, the stock is up 5x from its IPO price, which was around 1,100 rupees a share. So multi-bagger turning out to be is HDFC AMC. But some of the other movers within the broader markets, Metropolis is among the top gainers today on the Nifty 500, and that of course is on the back of some rising cases in the city of Mumbai with regards to malaria, dengue, and a lot of these other monsoon related illnesses. The stock is seeing a bit of a reaction today, 6.5% higher. Pull up Dr. Lal as well, just to see if that too has seen a bit of a reaction in response to the moves that Metropolis has seen. Not quite. The stock trades absolutely flat in today's session. So that is one of them. Zensar is the other one, 4.75% higher on that stock. And among the top losers, some of the other top gainers that were in yesterday's session are seeing a bit of a reaction today. Newland Laboratories has seen a very significant up move in the recent past, seeing some profit booking, 5.5% lower on that stock as well. We take this market conversation forward with Shisadri Sen, who's the head of research and strategist at MK Global, who's now joining in. Mr. Sen, good morning. Thank you for joining in. We are at a very interesting juncture when it comes to the market, be it our own or be it the global markets as well, because of the fact that there are so many moving parts, right? We are still awaiting clarity on the trade deal with the US, which is likely to happen based on what the US president has said by the 1st of August. We still don't know the contours of that. We are in the middle of an earnings season that has so far flattered to deceive. It's not been the most impressive start to the earnings season. Do you see the valuations to be justified, considering the fact that the macros so far have been relatively stable?
Hi, thanks for hosting me. A lot of questions packed into that, so let me take it one by one. In terms of the weak earnings season, yes, we anticipate a weak earnings season in this first quarter. While we are constructive on an economic recovery in FY26. We think it's going to be back-ended, and most of the earnings growth will come in the second half of this year. So from a medium-term perspective, the weak earnings season shouldn't matter. We don't think that there will be major earnings downgrades on the back of this weak season. But in terms of a near-term impulse, this is undoubtedly a negative. Secondly, on valuations, the 10% rally in the Nifty in the first quarter of this financial year has taken a lot of the valuation comfort out. We wouldn't say that valuations are in bubble territory. They are neutral. Most of the indices are trading at between long-term averages and +1 standard deviation. So that's not alarming, but it's not really comfortable for it. What we are saying is that from here, stock performance will be driven more by earnings growth rather than re-rating. The re-rating has done its heavy lifting in this last 3 months. And from here on, earnings growth and earnings upgrades will be the key driver for the market. So, and the other factor, the point that we are making is that in the short term, for the next month or 2 or 3, the markets are likely to mark time because, as you correctly pointed out, there are other moving parts as well. The trade deal will come through, and the full impact of that, I think, can only be assessed once it's announced. There are too many moving parts in that. And the impact of the monetary easing, while we expect it to come through strongly in the second half, is not visible yet. And near-term macro indicators are also sort of iffy. Growth numbers, monetary transmission numbers are, if you look at concurrent numbers, they are not very constructive. So our belief is that after this strong rally, you will see a little bit of a pause in the markets. And if we are right on our overall macro thesis that the rate cuts will translate into a consumption-led revival in growth in the second half, then you will see the next leg of market performance come in at that point.
Okay. Seshadri, I wanted to get your point on what's happening with the primary market. Suddenly, there's a flurry of IPOs. What does that indicate? Does that indicate that there is a froth now? Or do you think this is something which can indicate positive market sentiment as well?
For a longer-term perspective, I firmly believe that IPOs are good for the market. They help widen the universe. They help absorb flows and avoid bubbles getting created. One of the reasons why we are not into bubble territory yet is because despite very strong flows from both domestic and international investors, there's been enough supply to absorb some of that. And so from a long-term perspective, I'm not worried about IPOs and new companies coming to the market, especially when some of the macros in India are changing, some new sectors are emerging. It is logical that some of those will come to the market. Internet, ENS, so, you will see more and more companies coming to the market in some of those sectors, green energy, etc. From a short-term perspective, yes, it does create an overhang. But I don't think we've seen that kind of, there have been flows which match these IPOs, right? And therefore, it's not creating an overall pressure on the market. That is not, to me, a major worry. It's good for the long term, and in the short term, the market is healthy enough to absorb these IPOs and create. And many of these are very high quality companies which are coming through. So I don't think that is a major worry, at least from my perspective.
Got that. Seshadri, hi. So how stretched are the mid and small cap valuations right now? Which are the pockets where you think there is a risk that overvaluations will need to get corrected? And where do you see some pockets of a reasonable risk reward right now?
Overall, I don't think mid and small cap are overstretched on valuations. The optical high numbers have many nuances to it. In summary, the mid and small cap, post-COVID, that entire universe has shown better growth than large caps. With stronger, with improving balance sheets. And I think that's something that's missed. In the post-COVID world, cash flows have improved, ROCs have improved, debt has gone down in the small and mid-cap universe. So for them to be trading at slightly premium valuations is not a surprise. Moreover, it is also down to sectoral composition. We did a piece some time ago which pointed that out. The large cap universe is very heavy in some structurally low PE sectors like banks and energy. Whereas the large cap, the small and mid cap universe has a much smaller share of those sectors, which is why optically the valuations look easy. If you break it down and look at sectorally, there is not a case to be made that there is a large bubble building up there. In terms of where do we find value in terms of the large and you're absolutely right. With the indexes trading in the 30s, there are pockets of overvaluation. So with, as I said, when the valuation comfort goes, you've got to be more selective. Where we like small and mid caps, auto and auto ancillaries is one space where you're finding reasonable value. I think in that consumer discretionary space, you will find industrials is the other area where if you look hard enough, and especially the power ecosystem, there are plenty of opportunities for the small and mid cap. In some sectors like FMCG, which I'm structurally bearish on, value will be found in the small and mid cap space because that's where the market share gains are coming.
Interesting, bit of an anti-consensus call on the financials, Seshadri. I remember speaking to you about this the last time as well. You still continue to remain underweight on the sector. Is the NIMS compression worry the only factor behind why you remain underweight, or there are multiple other factors as well that keep you on the negative side when it comes to what is possibly pretty much a consensus bullish call on the street?
Near term, it is NIM compression for certain. There is a small worry I have that the street is underestimating the quantum of that NIM compression, and therefore you may see a little bit of earnings downgrades coming through in the short term. But my view is not based on that. My view is a more longer term structural view where the banking market cap is largely composed of private sector banks. And the large private sector banks have seen a structural fall in their growth rates. I've covered this sector from the beginning of the century, and we've defended 4 times price to book for some of these banks because they were growing at 25%. Now most of them are struggling to grow above mid-teens. And once your growth falls to that level, then it's difficult to sustain the high price to book. Admittedly, some of those price to books have fallen, but even a 2.5 time price to book is very difficult to be supported by just a 14-15% ROE when you're not even 14-15% growth when you're not even exceeding your ROE in terms of growth. Moreover, profitability is becoming more difficult to find. So it's a structural call. It's not just the names.
We get that point. Thank you so much for joining in with your insights, Seshadri. Always a pleasure speaking with you. That's the word coming in from MK on Indian market outlook. But for now, we'll slip into a break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that.
Welcome back. Shifting focus now to commodities. Manisha is here and she will be talking about crude oil prices. Manisha.
Thank you for that, Hormuz. I'm doing that because after 2 days of decline, there is some support coming back in case of crude oil prices. We seem to be holding around that 69.70 mark. What the street also is looking at is improved demand signals, especially coming in from US and China. It is summer travel season in most of the Western world. It's holidays there. And the rise in gasoline consumption is what really seems to be supporting the markets. Well, that's about US. But when you look at the Chinese market, whether it has been about manufacturing numbers or the second quarter growth, which has been better than expectations, also leads the markets to believe that China, which is the largest consumer for crude oil, could be looking at improved demand going forward. And then there was an OPEC report projecting strong global economy in the second half as well, and in anticipating that the demand will be stronger, especially from countries like China, India and Brazil. Markets also are looking at OPEC's June output, which is 41.56 million barrels per day, which is higher than what we saw in the month of May, but still lower than what the OPEC has introduced into the markets as additional output production. So those numbers lagging also has been supportive. It also is about API, which is suggesting that 10.1 million barrels of increase in inventories is what we could be looking at. This clearly means that there are refinery runs which have declined, and that indirectly is supporting prices at this point in time.
Okay, all right. Thank you so much, Manisha, for joining us as always and telling us what's happening in the world of commodities. With that, we'll slip into another break. Alok Mishra from Microfinance Institution Network will join us next. We'll talk about the microfinance sector and what's happening with rate moves there. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's talk about microfinance institutions. They appear to have raised their lending rates even after a percentage point reduction in policy rates in the country. To discuss this and more, we are now joined by Alok Mishra, CEO and Director at MFIN. Mr. Mishra, good morning. Thank you so much for joining in. Well, there are reports suggesting that MFI institutions, they've gone ahead and increased their lending rate. This is despite the 100 basis points cut that we've seen in repo rate. First, is that true? And second, if it is true, what is the reason?
Yeah, thanks for having me here. And it's a very, what should I say, a technical topic. So give me some time to explain it. Number one, when you refer to the reports, I think you're referring to a specific report which says that the 2 or 3 institutions have raised their lending rates. Let me tell you that we track the data on monthly basis for all our member NBFC MFIs. If I compare Q4 of the last financial year and Q1 of this year, I don't see any movement overall in the weighted average interest rates. It has remained in the same range between 23.6 to 23.7. 1 or 2 institutions might have raised their interest rates by 15 basis points or 20 basis points, depending upon their individual situation. That might be true. And that is true. I should not say might true, that is true. But we have to look at the larger perspective. And when it is linked with repo rate cut, let me tell you the critical fact that while you rightly say that the repo rate in 2 stages have been cut on 100 basis points, if we look at the cost of funds which the NBFC MFIs get from banks, the reduction has hardly been not even 15 or 20 basis points. And on top of it, the lending to the microfinance institutions has got reduced by 53% year on year, if I compare Q4 of 24-25 with Q4 of 23-24. And what that entails is that not only has the repo rate not been fully transmitted, because the last cut was only in June or July, it will take time for the repo rate cut to transmit. And we all know that transmission takes time from banks to NBFCs. So first, that has not happened. Second, the bank funding has got slashed by around 53%. And because that has got slashed, the other sources of funds which you have to rely on are a little costly. But despite that, the sector's overall weighted average interest rates has remained range bound. And as a proof of that, let me also tell you, the other proxy indicator can be, if you look at the financial results of FY 24-25, quite a few of our top players also have incurred losses during the year because the credit quality losses have come in.
So going ahead, on an industry-wide basis, on an average, do you expect the rate hikes that we've seen from 1 2 institution to spread more? Or do you think the repo rate cut will now kick in and on an average the rates come down? I mean, what's going to be, and give us a timeline.
The timeline has to come from the banks. If the funding starts and if the funding passes on the transmission of the rate cut, From our side, what we can say is that the credit quality worst period is over. Now the credit quality is getting back to normalcy. That should come in by Q2. That we are already started the Q2. By Q2 end and start of festive season, it should get to almost to normal level. If the bank funding also resumes to the levels which we saw in previous years, and the rate cut is passed on, I am sure that the rate rationalization will happen sooner than later.
Have you all spoken to banks? I mean, are they willing to lend? I mean, last year you said funding was down 53%. What was it in the last few months?
When I say 53%, I was referring to the cut. If I look at Q4 of last year to Q4 of even year to that. So regarding banks, as you would be knowing that last week we had a symposium of NBFCs with organized by DFS, where the Honorable Finance Minister had an interaction with us. We have requested our request, and even the Honorable Finance Minister has exhorted the banks to start lending. We hope, and we are also making efforts talking to the banks, giving them confidence. So if the lending starts and the rate cut is passed on, which RBI has done its job, now it is for banks to do the job. And rest assured, if it comes to us, we will do our job.
Okay. Mr. Mishra, where are we in the cycle? In the past, we've seen data suggesting cyclical nature of MFI segment, but it does see a sharp rise after the problems that we see. Where are we in that cycle? Do you think it has bottomed out?
Well, it's a very good question. And again, it will require a largest answer, but let me give you a brief answer to it. I see that, there are the problems come from two angles. One is if there is excessive lending or over leveraging or external impact. Last year, what we saw in pockets, I would not say that everything was hunky-dory. Yes, there was some stress. Plus, there were a lot of external events, starting with non-state actors disrupting credit discipline. Even Reserve Bank had to intervene and issue a press release. So that is, I think, almost contained. Credit cycle, all the guardrails which we have put in, all the members and even the banks and SFBs who are our members are following it. That is also being followed. So I feel if we continue that path and there is no major external disruption, the worst is over.
Okay, so the worst is over. That's a big statement. And thank you for explaining that to us so comprehensively. And always a pleasure speaking with you, Mr. Mishra. Thanks a lot for joining in today with your take with what's happening in the industry as of now. So the word coming in is that lending rates are largely stable. There are credit cost issues, and that's the reason some of the players have gone ahead and increased lending rates by, say, 10 to 15 basis points. We'll slip into a short break now. When we return, we'll discuss market technicals with Mitesh Thakkar and also discuss his top trading bets.
Welcome back. Still 50 points lower on the index. Some flashes on your screen there. Premier Explosives has bagged an international export order for the supply and manufacturing of defense explosives worth 105 crore rupees. The stock seeing a bit of a perk up after the order win. So 2.75% higher is Premier Explosives at 550. Mitesh Thakkar joins in now for a quick chart check. Mitesh, thank you for joining in again. You mentioned that your bias remains towards the downside. You still expect the Nifty to grind lower towards the 24,900, 24,800 levels. And of course, your stock recommendations for the morning.
I think that's a very strong possibility, given the fact that today is to a certain extent the bank Nifty, which is kind of supporting the Nifty. Otherwise, we could have had a much lower level. So I believe that a retest of 25,000 is very likely, and maybe 24,860. And this negative view will hold as long as we don't get past 25, 300, 325 zone. So in that sense, yes, I think, the chances of downside declines are possible. On the stock side, I have a buy on Maharashtra Seamless with a stop at about 719. Look at targets of around 765, 770 to begin with, maybe even higher levels, but that's the initial target. And the other one is Alchem Labs. Disclaimer, we have some positions over there on the future side, so there's vested interest, but Alchem Labs could be bought with a stop just below 49.85 for targets of around 50.80.
50.80 on Alchem Labs. Stock is spiking up, in fact, as we speak. You can see that in the price action. Thank you very much for joining in. Just a quick word on Just Dial. So that's under pressure post the Q1 numbers. The reason number one is growth for the company has slowed down. About 5 quarters back, it had a growth of close to about 16%. It came down to 13.6%, and then it started moderating to single digits. And in the last quarter, it came in at mid-single digits, a 6.2% revenue growth on a year-on-year basis. And that chart will come up for you on your screen. Paid campaigns, too, have slowed down. From high single digits, we are looking at low single digit kind of 4.3% kind of paid campaigns growth. The question is, margins are resilient so far. Margins have come in at 29%, but will they be sustainable? The business development related costs, according to Ambit, they say the business development related costs are now starting to creep in as the company has restarted with sales force hiring and ad spends. So therefore, they believe the ad spends are not sustainable. Last year, the company's overall margins were in excess of 29%, and they believe this will come down to 25% by FY28. So they have a sell rating. As they say, the revenue growth trade-off with margins will continue. On the positive side, though, the cash on the books, right? The cash on the books is nearly 5,500 crore rupees. Citi has a buy call on Just Dial. They say undemanding valuations. Because if you look at the valuations, X of cash, cash accounts for more than 2/3 of the market capitalization. X of that, the stock is trading at sub 8 times forward multiple. And then you've got that potential for cash deployment, which can boost growth. So that's the Citi view, which is why they have a buy call with a target price of 1,100. But for the day, the stock is reacting to slowing revenue growth. And now revenue growth for the company is down to mid-single digits.
The lowest point of the day is Just Dial. Citi, though, remains optimistic, but the street, as of now, not quite. The stock did open higher, but since then has seen some selling pressure. Take a short break. On the other side, we bring you excerpts of our conversation with Network 18's Rahul Joshi over the first quarter performance. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Network 18 at that stock has rallied over 12% in trade post its Q1 FY26 numbers. Margins have improved for the company while viewership share has risen too in the quarter. Our colleague Prashant spoke to the company's managing director Rahul Joshi and began by asking him on the company's revenues and margins and also on the overall environment going forward for the business. Listen in.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%, but from last year it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops.
Rahul, just one number out of the way, and then we can get into specific segments, etc. You've recorded exceptional gains from an investment revaluation in this quarter. Outside of such one-offs, Can you tell us when do you see the total business returning to consistent profitability? I mean, what's the timeline like?
No, so that number that you see there is because of assignment of voting rights to Inadu in light of, the CCI dictated sort of order at the time of the merger of Viacom 18 and Star and Disney and Viacom 18. So that, so we had to market to fair value and not at cost. So which is why you see that bump up in that number. So that explains that part. And I think that, in this first quarter, we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs, under control in our existing businesses. Costs are marginally likely to go up only in our new investments, maybe in areas like First Post or in money control. So overall, I am hopeful that, the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. I think we'll have to keep an eye on the earnings next quarter. And so things are looking up, but I wouldn't rejoice at the moment.
I mean, the festive season is going to be upon us. Is that typically that is a bit of a that gives a bump up, a tailwind, right, to advertising revenues?
No, yes, of course it does, because clients are waiting for the for the sentiments to improve, for the festive mood to kick in, and that is when they also open their purse strings. So I remain hopeful that July is looking slightly better. I wouldn't be very excited yet, but I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We've only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
Advertising, of course, is outside of one's control, but you've at Network 18 driven and focused on subscription revenues in a big way through platforms. I mean, reach is 300 million. Money Control Pro has done quite well, but that question still comes up. Can subscription revenues really scale in a big way in a price-sensitive market like India? And you're doing this across properties now. Could you give us a sense of what's happening in each of these properties?
No, that's a good question, and I'm glad you asked this. 4 years ago, when we were embarking on our subscription drive with Money Control Pro, there were a lot of people who told me that you will not even get 10-20,000 subscribers. It would be a huge success if you manage to get that number. So we started with $999 per annum, and very quickly we notched up a number of 1 million in 4 years. 4 years, we hit the 1 million mark. Now that is quite remarkable. We were so enthused by the success of this that we have now launched something called Money Control Super Pro, priced at 2,500 rupees per annum. It's just 2 months that we have launched it, and the numbers are really heartening. So this gives me reason to believe that the naysayers, were entirely wrong. There is a market for where people are willing to pay. If there is high quality content, if there are tools that will enable traders and retail investors to, in their investment journey, there is every reason that they will pay. So on CNBC also, we have started something called CNBC Access, 10,000 rupees per annum. So we're getting more and more ambitious. And 10,000 rupees, it is not like Super Pro or Pro, which is only giving stock advice or tools, but it provides, it sells the entire CNBC experience. So you'll be invited to all the events, you get to interact with the anchors, you get to visit our studios, you get value-added shows, you get exclusive interviews only behind the paywall on CNBC Access. So we are hopeful that we'll be able to crack this 10,000 rupee price point as well. So as you see, our price points are only going up. People are continuing to pay. The question is, if you are India long and you take a punt on the economy over the next 10 years, it remains the fastest growing economy in the world. I have every reason to believe that subscription is the only way forward. The people who latch on to this early on will be able to reap the benefits in time to come.
Absolutely. I mean, media is one of the top consumption sectors and is a play on consumption. So for these two, Money Control Super Pro, CNBC TV18 Access, if you can give us an early sense of how these, it's very early, but I mean, are they doing as well as you thought? And can they become sizable revenue streams going forward? How long will it take, the journey take, in your opinion?
So, just to give you, I can't speak numbers and I don't want to get into granular details, but let me give you a perspective. Money control till about 4 years ago was absolutely and only driven by one revenue source, which was advertising. Today, we are doing subscription through Money Control Pro and now more recently Super Pro. We also launched lending on our platform. We do unsecured lending on our platform. No default risk on our balance sheet. We have onboarded partners, lending partners, and we get some commission from that. We've started that also as a new revenue stream last year. We've done almost a year of that. Very enthused about the performance and how we have done in the lending business. So as you see, we are moving away from content, advertising to subscription to even lending. And if I were to give you an idea, maybe last year from 100% advertising, we did about 70% advertising and 30% non-advertising revenue. Right? I am reasonably sure that over the next few years, this will substantially change in favor of revenues and in favor of subscription revenue and other forms of revenue. That is the only way we'll be able to grow our business. We have to keep growing advertising. This does not mean that if advertising becomes 50% in the next 2 years, that's not growing. That's growing as well. But the overall pie is growing even faster.
Absolutely. Can you give us a split between advertising and subscription as things stand right now? And where would you like this ideally to be, that number, that split?
So I gave you the example of Money Control. I'm not giving you the, because subscription also means television subscription. We get a sizable number from the television subscription revenue as well. That continues to be, subscribers are falling off, all cable and DTH operators. They're reporting lesser numbers. But for us, our revenues are very stable over the last few years because we are a large group. We have large number of television channels. So it's a big bouquet. So that continues to give us the benefit. I don't want to say anything on the numbers at the moment and what is my prediction over the next few years. But I was giving you the Money Control example to tell you where things are moving and how we as a group are prepared to exploit this.
Is there a broader, and this is a question we ask to most CEOs nowadays, Rahul, with these very fast developments in AI and AI being used to increase productivity at pretty much everything that one does in the workplace, how is that, does that kind of sort of go into how you think about workforce requirements? I mean, in the news business, people are the biggest expense in that sense. How do you think about this?
Our biggest expenses are, talent cost, people, distribution, because we have to, invest behind distribution and reach, and also tech. These are the three large cost pillars for us. Now, if you look at our existing businesses, they are mature businesses. Costs are not really going up there. In fact, we are being able to achieve cost efficiencies there. AI is helping in a big way. We have recently nominated an editor who's our AI head. One of the few companies in India to do that. We have a CTO who only focuses on AI initiatives. So we are adopting AI as a very critical, element in our work process and making it more and more efficient. So going forward, we will not hire talent in areas where we can use AI to get better efficiencies. We will hire talent, which will add impact to our business. So that is the way to look at the entire business. I think AI is helping in a big way. Across the group, a lot of AI initiatives, not only to look at efficiencies, but also to look at driving traffic, engagement, and many other ideas. So that's how we look at AI.
And a standard disclaimer on your screens, Network 18, a company that operates CNBC-TV18, is controlled by the Independent Media Trust, of which Reliance Industries is the sole beneficiary. Take a short break here on Trading Hour. The index has recovered from the lows of the day. Now just 25 points lower is where the Nifty stands. So an interesting move from the lows. Take a short break. Back on the other side.
Welcome back. A definite recovery in the markets, and that's led by some banking names. So the banking index also has recovered. It's up around 30 points as we speak, but it continues to be about IT, right? We do have Tech Mahindra that is reporting numbers and L&T Tech Services as well. Rima, let me start with Tech Mahindra first. What are we expecting?
Well, expect the second consecutive quarter of a revenue drop. So on the top line, dollar revenue is likely to go up by 1%, but constant currency, that's expected to drop by nearly 0.7%. And as I said, this will be the second consecutive quarter of revenue weakness. Where Tech Mahindra has been improving has been on margins. Margins have been steadily going up now for the last 6-7 straight quarters. In fact, margins may have bottomed out in Q2 of FY24. That's about 7 quarters back, and margins were at 4.7%. And since then, they've been steadily inching up. 10.9% is our poll for Q1, but the company's aspiration is to hit 15% margins by the end of FY27. So we still have some time to go. So how does the company get to those margins? And they'd also said, as a part of Mohit Joshi, who is the CEO, as a part of his turnaround plan, he also wanted to get to industry-leading growth by the end of 3 years, which comes to an end in FY27. So, the path to that, this turnaround progress will be tracked very closely by the street.
Interesting. And what about LTTS, Rima? That too reporting results right now?
Indeed. So for LTTS, it's expected to be a muted quarter. Revenues for the company are seen down 2% on a quarter-on-quarter basis. Constant currency revenue growth is likely to fall even more, down close to about 3%. This is an account of weakness in one of the businesses, Smart World SWC. Even high-tech has been a bit subdued. Automotive has been under pressure. So the outlook for mobility has been weak too. Margins are likely to remain flattish, so 13.4% versus 13.2%. Now, here the big question is, last time the company did acknowledge that, Q4 didn't pan out as we were expecting. We thought we would grow, we didn't. But we still hold on to a double-digit revenue growth in FY26. Now, does the company maintain that? Because Q1 is going to be soft. So that is going to be the crucial part for L&T Tech. That does the company hold on to its double-digit revenue aspiration? Back to you.
All right. Thank you so much for telling us what to expect from these IT names today. For the markets, there is a further recovery now. The Nifty is down just 9 points. We do have the Bank Nifty, which has surged to levels of 84 points. The likes of Asian Paints, there's Tech Mahindra. Some of these consumer names actually are also batting for the bulls as we speak. So Asian Paints at the day's high, Tech Mahindra doing well. Tata Consumer is the other one which has recovered. Nestle, Wipro, Kotak Mahindra Bank, ITC. So a couple of these names lending support to the Nifty as well from the lows of the day. That's yes, Kotak Mahindra Bank recovered from the lows. So we'll keep tracking all the market moves for you. For now, we'll take your leave on this edition of Trading Hour. Stay tuned. Halftime report is up next.